Right. Assalamualaikum warahmatullahi wabarakatuh. Good afternoon, everyone. So today we're going to move to the next topic. We'll be talk about consolidation of fully owned subsidiaries acquired at more than book value. Okay. So right. So just for the opening, we're going to look at the cases related to how much work does it really take to consolidate. So, for example, in this book and on your book, you can just find it. So this is a Walt Disney company. So based on the history in 1923, the parent company to some of the most well-known business in the world. So Walt Disney Company is actually the parent company for the most well-known businesses in the world. So the best known for Walt Disney Studio, it's actually most people will be famous with the park and resort and also media operation, such as Disney Channel, right? So and the consumer products. So actually Disney is quite a diversified company, right? So you know that they yeah Walt Disney so movie probably for those of you that really like the movies so probably Walt Disney Studio you know about that and then also there is amusement park right so there's also a Disney Channel on TV so I quite you know turn it to my kids at home and it based on that we can see that the Disney is actually kind of the diversified company and there is also television network right so there is actually Disney have ABC television network and it's a majority owner so so in consolidation as and I mentioned before and as you got information before that it's working on involve a parent company and a single subsidiary. And Disney it employs a staff, right? So they put in California, they put in another headquarter. It's the quarter it will complete the consolidation in five segments, and each comprising many subsidiaries. Right, so its preparation for the actual consolidation begin before and the end of the fiscal period. So after the end of the period, each segment close its books and including perform its own subsidiary consolidation. So it will be work with independent auditor after that and prepare kind of the overall company consolidation. So the work continue as a finance and accounting staff approximately around 100 of the men and women, right? So they will review and analyze the result of the segment and work with the segment financial staff. They want to prepare what becomes the publicly disclosed of the consolidated financial statement itself. Right. But however, the work doesn't all take place at the end of the fiscal period because the accounting system track the intercompany transaction happened throughout the period. So remember, last meeting and why actually we need to do the elimination it will be avoid any mistake and probably because basically intercompany transaction happen during parent subsidiary it's just a one single transaction right so the money is just in there you know going in and out and then the consolidation process require the elimination of intercompany sales right, and asset transfer among other consolidations, right? So, and one of the reasons related to the Disney has grown and they're trying to become more diversified, right? So, there is three and more acquisition in like Marvel Entertainment, a Pixar Animation Studio. I think I've quite a lot of seen this one is it Pixar at a Pixar animation studio when you're watching the movie in the theater. So sometimes it's just come up before the movie started, right? So Disney paid more than the book value of each acquired company net asset. So the acquisition accounting rules require Disney to account for the full acquisition price, even though the acquired companies may continue to report their asset and liability on their separate book. Right? So the acquisition accounting require Disney to essentially revalue the balance sheet of this company. Okay. So the bottom line is the preparation of the Disney publicly disclosed financial statement is, yeah. And all right, so this chapter we will talk about understand the equity method journal related to the entity and including differential. So we just start from this one first. Right. So this is actually kind of the foundation that you've been got from the chapter 2 and 3, everyone. So in chapter 2 and 3, we focus on simple situation when there is an acquisition price is exactly equal to the parent share of the book value in subsidiary, where the subsidiary created. And in the chapter 4, we have the assumption and acquisition price differ from book value. Okay, so you got the difference, right? So there is a differential happens in here. Okay, I'm not sure that is really fit with the book, but I'm trying to show you. So if I can just make uh, if so, just try to put new slides in here. Just want to make more pictures of this one. Okay. So this is the illustration. There is chapter 2. This one here chapter 2 and 4 we talk about fully owned subsidiary, and chapter 3 and 5 will be talk about partially owned subsidiary. Right. So this is no differential in here. Chapter 2 and 3, but 4 and 5 will be with have the differential. Okay, between the investment and the book value. Right, so this is about the coverage, right? So in chapter 2 and the chapter 5. So this is a difference in here, right? So, and then the difference between the acquisition price and the underlying book value. So it happens when the investor purchase the common stock of another company, right? So the purchase price is based on the market value of the share that acquire rather than book value of the investor's asset and liability, right? So this is right. Okay, this one. So the differential happened because there is I want to write, but it's couldn't No, I think about it. Just use this one, guys. I'm just going to change it. Okay, so this is purchase price, right? So the purchase price is based on the market value, right? So yeah, usually based on market value. Mhm. And then there is another one is it's a book value, right? So the book value is actually from the book value from investees, assets and liability, right? So you have it different, okay? Now, so the acquisition price is usually different from the book value of the investor proportional share of the investor's asset, right? So because the purchase price is based on the market price, and the acquisition price is actually automatically based on the market price, right? So there is a differential happens in there, right? So Usually it's positive. It means that the acquiring company will be pay more than the share of the book value of the subsidiary. So in this case, there is an equity method investment happen. So the differential on the parent's book will be relate to the parent share of any difference between the total invested fair value and the book value, right? So the differential in the case of the equity method is implicit on the investment account on the parent book, and it's not recorded separately, right? So the cost of investment will be probably exceed the book value, right? So giving a positive differential. Okay, so we're going to check the example after this, right? So another reason could be existence of the unrecorded goodwill that associated with the excess earning power investee. Okay, so let's have a look at this one. What happened when you consolidate with the parent? So the parent investment is based on the actual acquisition price. So the parent need to make adjustment on the balance sheet and income statement account. And why was this problem with created sub? Because no goodwill, no undervalue assets over time creation. Okay. This is just goes to right. So I think I prefer to show. I'm just gonna check whether the example here is no, it's not related with the slideshow. So let me just change it, guys. So I think this is not quite relevant. Yes, because the PPT sometimes is not really full shown based on what has been stated in the book. Okay. All right. So let's have a look at this one. Okay. Now, so the first one, we want you to understand about and make the equity method journal related to the differential. Okay, so so there is stated that when this equity method is used, so the portion of the differential must be treated in the same manner. Okay, let's have a look at this one. Right, so this is talk about any portion of differential related to depreciable or amortizable asset of the investee. It should be amortized over remaining time of which the cost is related to the investee itself. So the amortization of differential associated with the depreciable and amortizable asset of investee is necessary, right? So the investee will recognize there is a reduction in surface potential of asset. So let's have a look at this example. The approach to amortizing the differential that is most consistent with the idea of reflected asset. So um, this is income from investee, for example, from X amount, and then investment income stock of investee this amount. So differential represents the amount that has been paid by investor in excess of the book value, right? So this is the one that should be highlighted here. Okay, let's have a look at the illustration here. How apply equity method when the cost of investment exceeds the book value of the underlying asset. So Ajax Corporation purchased 40% of the common stock of Barclay Company on January for $200,000. So Barclay has net asset on the debt with the book value 400,000 and the fair value 465,000. So the total difference is equal to the market value of the Barclay common stock, right? So because they purchased around 40% of the common stock, so they purchased it for 200, right? Okay, so we got here the differential is around 100,000 rupiah. So this is the entire differential here because it's net asset. The book value of its net asset is 400,000, right? And then the Ajax share of the book value Barclay net asset at the acquisition is 160,000 because they acquire only 40%, right? it's purchased 40%. So, but the 40% of the common stock Berkeley purchased by Ajax in the amount 200,000. So the cost of Ajax investment 200,000, and the book value it's 400,000 times 40%. Okay, so okay, so it's got 160,000. So there is a differential here around 40,000. Yeah. Okay. Mm. All right. So I'm sorry, I don't know why. Yeah, it's just shown up here. And then the portion of the total differential that can be directly traced to a specific asset, um, its Berkeley book value is around 60,000. So where can we get this number? Because it has been stated that Berkeley has a net asset on the deck of the book value, 400,000, and the fair value is 465,000. Okay, so the remaining is around, so 35,000 of the differential is the goodwill. So this one is has been kind of illustration. Um, right. So let's have a look at this one. And so after we got the remaining, this the appraisal of the Barclay net asset indicate that the land is worth 550,000 more than the recorded value, right? So in its equipment is worth 50,000 more than its current book value. So the adject 40% share of differential will be as follows. So the land will be increased around 50,000, 15, equipment increase 50, the goodwill increase is around 35,000. So the increased will be goes to Ajak 40% share, right? So we got the total here is 40,000. Yeah. So 26,000 of Ajak share of differential is assigned to land equipment, with the remaining 400,000 that will be goes to goodwill. Okay. Right. So the book value here. So this is 200,000 investment in a Barclay company. Okay. And another information also stated here that um, although the differential relate to the Barclay asset, the additional costs incurred to buy a JAG acquired claim on Barclay asset is reflecting a JAG investment in Barclay. So there is no need to establish a separate differential account, and separate accounts are not reported on AJAX blocks to reflect the apportionment of the differential to specific asset. Okay. So the amortization or write-off the differential is accomplished by reducing adjacent investment account and the income that are recognized from investment in Barclay. So because land has an unlimited economic life, so the portion of differential related to land is not amortized. So AJAC 20,000 portion of differential related to Barclay equipment is amortized over the equipment remaining life. So if, for example, equipment remaining life is 5 years, so annual amortization will be 20,000 divided by 5. It's going to use the straight-line depreciation. Okay. Right. So this is just statement related to the goodwill. So the goodwill, if it's so this the standard state that the equity method goodwill is not amortized, nor is it separately tested for impairment, right? So it's been stated if there is any impairment happen, is there any impairment loss happen? So it will be explained, and entire investment is tested for impairment, right? So you know impairment, right, everyone? So um, kayak penurunan nilai ya, impairment. So Berkeley will report net income of 80,000 at year end and declare dividend 20,000. So what could be the recording here? So when there is a purchase of Berkeley stock, um, right? And okay, this is the journal entry. Okay, 200,000. So there is an investment in Barclays stock, 200,000 and will be paid cash, 200,000 rupiah. And then the equity method income here reported around 80,000. It means that we have to times with the 40% acquire, yeah, portion, proportionate share, right? So it's 40%. And then recording an investment in Barclays stock and income from Barclays company, 32,000. So and then there is a dividend declared. So it means that the Ajax got the dividend from Barclay around 20,000 times 40%, right? So and after that there is um, yeah, it's 8,000 investment, right? So recording dividend and amortized related to the equipment for 1 year is 4,000. Okay, so this is the journal entries. So with this entries, a Jack will recognize 20,000, 28,000 of income from Berkeley, right? And then, yeah, yes, income from around, okay, so you got the idea, right? Because the income in here, 30,000, and after that, debited around 4,000. Okay, income and adjust investment, ending balance is around 220,000. Yeah, the investment in here is you can just use a T account, investment, investment in regular stocks, investment in regular stock. So there is total in here will be stated around related to the investment in Berkeley, right? So we got 220,000. So that was the number, right? Okay. So another information where we talk about the disposal of differential related assets. So although there is a differential is included on the book of investor as part of the investment account, it's actually related to the specific asset. So if investor disposed of any asset to which the differential relates, so the portion of the differential must be removed from investment account. Okay, so this is the one that should highlight. So when this is done, so the investors share the gains or loss on disposal of the asset. It should be adjusted and reflect the fact that investor will be paid more for the share, portion of share. So let's have a look at the example. The Barclay sell the land to which 6,000 of Ajax differential relate. Ajax doesn't recognize a full 40% of the gain or loss on the sale. So assume that the Berkeley originally had purchased the land for 75,000 and sells the land for 125. Okay, so Berkeley recognize a gain on the sale around 50,000, and a Jack share of that gain is 40%, right? So it means that 20,000, yeah, 20,000 here will be goes to the Jacks. The portion of the gain actually recognized by a Jack. However, it should be adjusted by this amount. So the Ajax share of the Barclay reported gain is 20,000, right? And the portion of Ajax differential related to the land is around 6,000. Okay, so actually the gain that been got by Ajax is actually yeah, we got okay, right. So this one we got maybe 600 here. Okay. So so at the end again to the recognized by Ajax is around 40,000. So if Berkeley reported an income, including the gain on sale of the land, so the recording of the Ajax would be like this: investment in Berkeley. It's recorded equity method income. It's 150. We times with 40%. Right. So and after that, remove the differential related to Berkeley. The differential will be removed because the land has been sold, right? So um, yeah, we uh, make the entries like this. Come from Berkeley, investment in Berkeley will be reduced around 6,000. Okay. All right. Okay. So now this is the consolidation procedure when there is differ when there is a differential. Okay. So right. So I'm just going to have a look at this one. So it has been mentioned that there are a lot of factors that affect the fair value of the company and also the stock price, including asset values, and cover, and general market condition will be, sometimes given effect to the different situation. So when the company acquire another, so the acquired fair value is usually different from its book value. We call it as a differential. So the process of preparing consolidated balance sheet will be after a business combination. Um, let's have a look at this one. The illustration, the acquisition subsidiary, when the consideration given is greater than the book value of the net asset. So in this example, we use the example that has been stated before on the peerless and special fruit. So remember in chapter 2, we use the peerless and special fruit. So we assume that the peerless product acquire all special fruit outstanding stock on January 1. So they pay around 340,000 by cash, right? So the amount equal to special fruit fair value as a whole. So the consideration given by PLS here is 40,000 rupiah, $40,000 in excess of special fruit book value. It's actually 300,000, right? So this is a fair value consideration here, okay? So the fair value consideration here is 340,000, and the book value is this amount we got from the fair fuse caution, right? So the difference between fair value and the book value is 40,000. So the recording of the stock acquisition, investment, special fruit, and cash, and around 340,000. Right. So in a business combinations, in consolidation, following a business combination, so the full amount of consideration given by acquirer it should be assigned to individual assets and liability. Right. And in this example, the fair value consideration is actually extra 40,000 for acquisition of the value of the land. Okay. So this is around the relationship between the fair value of consideration given. So book value 300,000 and the excess is 400,000, right? So the initial investment is special for 340,000. So the PLS will prepare a consolidated balance sheet on the debt it's acquired special fruit. So the consolidation worksheet procedure used in adjusting to proper consolidation. So this one, the first work entry, right? So the basic consolidation entry will be eliminated the book value portion of the parent's investment. So this is book value at acquisition, 300,000, stated comprised common stock and return earning. So the worksheet entry to eliminate is cost to basic consolidation entry, common stock, return earning, and investment special fruit, right? So, so if there is a situation that is excess value, um, so the differential is additional 40,000. Payless paid to acquire special fruit because it land was worth 40,000 more than expected. Right. So the T account will be like this for the acquisition price. So this one, 300,000 before, right? So the amount is um, reflect to this part. Okay, and this is for the land. So you see that there is the zero in consolidated. Okay, so I think it's enough for this the first video. Thank you everyone. So this is a registered goodwill. Thank you. Assalamualaikum warahmatullahi wabarakatuh.